Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments and subscribers. I greatly appreciate it. This week up, we're going to take a look at the Chinese e-commerce behemoth, JD.com, that sells everything under the sun on the online portal. We're going to go through, behind me is their most recent annual filing. We're going to go through it, look through the income statement, balance sheet, cash flow. We're going to forecast, we're looking at 9 years of historical information. We're going to forecast that forward. We're going to figure out what we think it's worth today. And if we bought it now and held the stock for 10 years, what kind of return could we get on our money as a safe, prudent investor who is focused on cash flow investing? Ready to get to work? Let's do it. Before we dive into the 10K, let's review the 5 key attributes for rational investing that we use here in this channel. And those would be top line revenue growth. We want to have a company that's growing their top line. Earnings growth. We use EBITDA, enterprise level earnings. That needs to be growing. We need to see strong free cash flow. We want a company that's got less than 3 times debt to EBITDA as a hedge for bankruptcy for risk for us. And fifth, we need a well-priced stock, well-priced being enterprise value to EBITDA or cash flow yield. We use both of them in this channel. We need those all 5 to line up, as well as a number of other intangible items that we can cover or you can cover in your own to make an investment decision. But for us, this channel is dedicated to the cash flow investor, and we're going to put our cash flow hat on as we go through JD.com. The next thing I want to say about this 10K, it is extensive. It is 703 pages long. They have absolutely included everything in this annual report, and I highly suggest that anybody's interested in truly understanding how a business is run to get this report and read the whole thing. For example, they have entire purchase agreements of acquisitions they have made in here. They have entire sales contracts in here. They have corporate management comp. They have everything under the sun, not just the standard 10K, but they have attached, rightly or wrongly, almost everything, every document that they include in this company. So it's a really robust read. I would highly recommend doing it. If you want the actual financials, they start at about 190 or so when the actual financials come in. But let's take a look. So behind me is the balance sheet for JD.com, and I want to point out a couple things that I thought was interesting that I haven't seen in many other 10Ks that we've reviewed, and I'll call them to your attention. First and foremost, let's center ourselves. The fiscal year end, December 31st, you got 2 years of financials here that's stated in RMB, and then the last column they've converted into USD for us. But what I want to bring to your attention here is both the cash on hand at $13 billion, but this restricted cash line of $680 million. Excuse me, that's $13 billion. That's $680 million. What is restricted cash? Restricted cash is cash that you should not consider cash. It is not usable for the company's purpose. It's basically money that's in a lockbox, or it's tied up by some sort of credit agreement or an acquisition they did where a lender has said, hey, I want you to set aside a certain amount of cash as cushion, as collateral for me alone, and you can't use that. So they're forced to call it out. You always want to be careful that if you do see that on a balance sheet, you do not use it as any cash for the business. Basically, the business needs to meet certain criteria on operating standards for the bank to release the cash to be used in the business. And that contingency means that us as equity investors can't rely on that money for the business. If it should take a nosedive, that cash is protecting someone else. But overall, I thought the business was fairly clean and the balance sheet was pretty clean. Let's go to the income statement, and I'll show you a very simple income statement. Net revenues here, $114 billion. You've got operating costs here, and they make about $1.9 billion last fiscal year for them in their sales on $115 billion top line revenue growth. That's about a 1% number. So that should spark in your mind really thin operating margins. We want to check cash flow to make sure cash flow is representing that number. But these are pretty thin operations as they try and scale their business. A lot of what they talk about here is trying to gain scale to make this operating leverage, the cost for logistics to pan out. So hopefully this number here can get get larger over time. But right now, their operating income is extremely thin. Another thing I want to point out is why I use EBITDA as a metric. You can use operating income as well, but I don't use net income or EPS. And that's because there's a lot of stuff like garbage below the line, as I call it, or it's often referred to as the line. But it can be interest expense, which is normal. But then you have the share as a result of equity investees. Like, what is that positive number? That's a non-cash positive income, so it's affecting net income. And if you use EPS to value a stock, you're including this, which is not cash, and it's kind of a one-time deal. It's affecting your net income. Some of the other things here, if you scroll down, this is not the full net income. You got to keep going to comprehensive net income. You get foreign currency translations, minus $1.2 billion. Unrealized gain loss, $108 million. So gain and sale on securities and assets, $8 million. This type of noise distracts from the underlying operating cash flow and earnings of the business and affects the net income line. So when you look at EPS, earnings per share, it's this line divided by shares, which is affected by all the other stuff that I just discussed. If you go up in the P&L, you move higher in the P&L. Yes, you don't capture everything, but you get to distill out into a normalized level of operating earnings. And that is what EBITDA attempts to represent. I grant you poorly in a cash flow, but you get above some of the noise, because if you're holding the stock for 5 or 10 years, a lot of this stuff here is going to ebb and flow, and you don't want to judge your decision to buy a stock based on a one-time blip down here. You want to focus on a quality number, so you kind of have to go up in the P&L a little bit. But that's a little story. Let's go dive into the financials and really take a look and see what we see. All right, behind me is the JD.com 9 years of revenue. I've converted these into USD in millions for convenience. We start here $6.6 billion in 2012, and they've grown that to the most recent number, $114 billion, which you saw earlier. That's phenomenal growth. When I look recently, the year-over-year growth is solid double digits, a lot like we've seen from the other e-commerce giants in China. They are growing at an astronomical rate, maybe even blistering rate. I like that term, a blistering rate. Profitability, does that translate to what you and I buy, which is earnings, cash flow ultimately, hopefully. You can see here they're losing money when they're not at scale. They start scaling, and profitability does turn around, and it is growing. Kind of dips here a little bit, but in general, it is growing. It's super thin on the margins. You'll notice that. So $82 billion of revenue, $1.5 billion of EBITDA, $114 billion. I mean, that's what, 36, if the mental math, $36 billion increase in top line revenue, and they only kept $1 billion of that $36 billion increase in revenue. So they are growing, but it's not tremendous growth. So in terms of operating margin, but it is growing, it is positive, it checks the box for us, albeit these negative numbers is throwing off my averages, that's fine. But if I look in this region, it's definitely growing, so I'm going to check the box. Let's move forward and get enterprise value. Enterprise value, obviously going to start with debt. It's the first thing we want to pick up, the current and long-term portion of debt. They don't have hardly any excess cash. I'm pegging it at $9.2 billion. You saw on their balance sheet they had $13+ billion. I said they don't need all of that to operate. I'm kind of giving a swag at a number. I have $9 billion, basically netting out this to be zero, which means they have no actual debt. Market cap, shares outstanding times average price, and then enterprise value being debt minus cash plus market cap. Enterprise value, $128 billion at the end of their fiscal year. The stock's pulled back a bit from recent news, so this is using an $82 stock price. It's currently now at 70 some odd. We'll get there in a bit, but bear in mind this number is from that higher elevated stock price. That puts it about a 50 times enterprise value multiple. You can see it's been higher than that early on. It came down to about a 32, which is a nice deal. It's currently ticking up in the 50s, but not unreasonable for such a growing company. I think I would always want something cheaper, but it's kind of hard to look strong double-digit revenue growth in the face and say, how I want it less. That seems to be the market multiple in this day and age that we are seeing for companies like this. But someplace in this range, I don't think it's cheap, but I don't think it's too expensive. We'll see when we grow it if it pencils out to be an above-market return. Debt to EBITDA, net debt to EBITDA is 0 for us, so that definitely checks the leverage box. All right, let's go to cash flow. All right, cash flow statement, my absolute favorite statement. Cash flow from operations CFO, I'm pulling that directly from the cash flow statement. It's always the third statement following the income statement on the disclosures. 2012, $225 million, grows to $6.5 billion. Now, I thought this was pretty interesting that the cash flow from operations is significantly larger than the EBITDA. So I think the EBITDA they have has, I'm guessing, some other costs in it, or rather, the P&L has some cost in it that are still sitting there, such as like share-based comp, and some other transaction costs that are suppressing the EBITDA. But when I look at it in terms of cash, there's $6.5 billion of free cash flow. A nice spike and a continuation of a trend there. It's not perfectly linear. It seems to flatten a little bit and then spike. But cash can often be, the timing can affect the cash. If you delay a payment to someone, then it shows up as positive cash. If you accelerate a payment to people, then it's a negative cash. So sometimes this can be a little less smooth. CapEx, for a software company, it looks about right. They're putting a lot of money into CapEx, but it is about 50%, or in this instance, a whole lot less than the cash flow that they're generating. So that checks the box for me on strong free cash flow, because in a single year, they can more than pay for all the cash they have to put back in the business to grow the portfolio, to grow the e-commerce platform. That means that this rest of this cash, this net difference, is available for us as an equity holder to pay debt service, which they have almost none, or to go make acquisitions. So I like that. Debt payment, a little positive, a little negative. Overall, it's a 0 for me. They have no debt, so they can continue to borrow in my mind because they're growing very fast. I'm fine with that. So when I look at free cash flow to equity, I'm just summing up these. This is what the business is based on. That's the true value of a company. If you think of what is a company worth, well, it's worth the present value of all future cash flows. You would take this number, stretch it out into the future with some sort of growth number, discount it back, and that discounted value is your current stock price. That is what this company is based on, and that's a very rosy, very curly $5.8 billion, which is a big number, and I love to see that. Shares outstanding, 1.5 billion shares outstanding. Divide the two, and I get $3.88 of free cash flow. Current, at least last fiscal year, $87 was the price target. It's now 4.4% yield. It's down from this. We'll see that in a bit. It's about $15 less than that because of some news that's hitting the market right now. China's kind of stepping into the app store, affecting which businesses are effectively towing the CCP line and which are not. So I think that's definitely going to add a risk to this transaction. I will let you judge that for your own. My job here is just kind of thumb through the numbers and render an opinion. The CCP argument and their influence is up to you. But overall, I'm seeing strong cash flow. I'm seeing EBITDA translate into cash, which is good to see. I'm seeing decent yields for a growth stock. If you're mid fours, it's probably a little higher than that with this. Actually, if I lower that number, 5.2. So if I put this to the current stock price, you're in the 5% free cash flow yield, which is a strong number for such a growing stock. Okay, let's take a look at the growth forecast. We'll forecast it forward and figure out what we think this business is worth in 10 years. Okay, for the growth stock, the growth portion of this analysis, it's extremely difficult to forecast this business, obviously. It's been growing 20 to 30% every single year for the last 6 years. Who knows what's going to happen going forward, especially with China stepping in and kind of manhandling their e-commerce platforms. I think there's an added risk to that. So what I've done here is pretty much applied our standard format to growth stocks. I'm carrying a 30% growth year over year from last year's 2020's EBITDA, and I'm growing it 30% to $3.3 billion. And I'm going to shrink the growth rate over time to a very reasonable, I think, 10% annual growth long-term, which is low in my opinion, for a $10 billion long-term EBITDA target for the company. And I think what I'm going to do is I'm going to apply a realistic forecast here. Then we'll look at the return and lay on the risk of kind of management risk, if you will, from the country, and figure if the return warrants the risk. But right now, this is a reasonable forecast for such a growing business over long term. I apply a 25 times multiple to that business because the multiple should come down. It's at 50-ish right now, should come down to 25 as growth comes down. That means a $250 billion enterprise value, less some debt, plus some cash, basically the same market cap, divide by shares outstanding at $168 long-term price target for this stock out 10 years. Okay, if I do the same thing for the free cash flow method, I'm taking free cash flow from last year. It did include the debt payment that they received in, but they have no debt. They're growing so fast. That's totally a dividend recap that they could do annually. I'm growing it 30%, shrinking it over time. I'm applying a yield of 5.7. Now, I do want to show that this yield here historically had a negative number here. I'm basically taking these two and averaging those, excluding this negative, to get me an average yield. And when I do that, I get 5.7, which is still high for such a growth company. Typically, you see yields lower for growth companies. Remember, higher yield, lower stock price, lower yield, higher stock price. They're inversely related. So 5.7% yield on $15 and change of cash flow, $271 price target. So two strong price estimates. Let's go look in the market and see what we can buy the stock for today. All right, so behind me is the two methods that we use to value a stock. One, the free cash flow method, $271. The other, EBITDA market multiple, $186 per share. That kind of makes sense because the free cash flow was significantly higher than the EBITDA that I have. So I've got a higher free cash flow value if they can support that continued free cash flow. And then I've got a lower EBITDA market multiple EBITDA based forecast because the market multiple is coming down over time. I averaged the two at about $220 a share out 10 years as an estimate, right? This is just math behind me, but it lays a foundation for what we believe the stock is worth and helps us ride the ups and downs because we have some logic to hold ourselves accountable for. If I look into the market, I can buy it right now at $72 a share. So I'm in at 72, I'm at 122, plus I get a fractional ownership of all the cash flow it generates over time. Let's see what that's worth. So behind me is the investment analysis of JD.com. I buy it at $72, so that's a negative, means cash outlay. I get a cash inflow. Now this is the free cash flow per share that I'm assuming they've dividend out every year. They obviously don't do it, but if they don't dividend out, they can buy back shares, in which case the shares outstanding that I have in this model will be fewer, which would make the stock price go up. Or they can take this free cash flow and go acquire other businesses or grow in another fashion, and hopefully that's profitable. So I think either way, you get this cash flow stream either as a dividend or in a higher long-term share price than I have here. But needless to say, in at 72, out at 220, this stream of cash flow gives me a 23% annualized IRR for holding this investment over a 10-year period of time. That's about a 4.5 times cash on cash return over the time, which is a very healthy, very strong return for this stock, especially at these all-time highs, some might say ridiculous valuation metrics that we are seeing here in the US. I am very concerned that the market is too frothy. I've seen this both in 1999 and in 2007, where things get euphoric and it doesn't end well, and I am very concerned about that in my own portfolio. That's one of the reasons I'm trying to look outside the U.S. to kind of help me figure out how to position a portfolio and maybe even just have more cash to pick up great value if there is a correction. But this being non-dollar based outside the U.S. economy, you have the rather substantial risk of the CCP getting in here and manhandling the business, but assuming that they don't step on any tail and this math exercise behind me pans out over a decade, that's a phenomenal return to achieve. Let's put this into a spectrum for you. If there is further bad news and the share price drop, the return gets even better. At $65 a share is 26% annual growth rate, which is anything 20% and up, by the way. If you take a financial calculator, you put in 10 grand or 50 grand, whatever kind of jack you have, 100 grand, you throw that in there for 20% return or 23% return for a decade and see what that number looks like without selling it, not paying any capital gains. No. You hang on to it for a decade, you let it continue to compound, and you'll see what you have is a nice curly number. That is how value investors make their money. They are not churning stocks. They're not buying and flipping and following green dotted lines and flashy lights. They don't care. They're sitting in a chair. They're reading a business plan. They're thinking, I believe in this company. I like the management. The valuation is reasonable. They're in a growing market, and they can pull it off. And they have a track record of pulling it off. That type of analysis, putting your money with those people and just letting it ride, is exactly how some of the titans of the industry have made billions of dollars. And I believe we can do it ourselves. It's not rocket science. It just takes a little work, most of which nobody is willing to do because they're all trying to get rich quickly. So take your time, read through the 10K. It's a great read. They are a tremendous company. I really wish them the best of luck, and I think it's a really interesting opportunity if you can get over the country-specific risk, but it seems to me like you're getting paid for it. So we're good at this channel. I like this stock. Let's review our 5 key attributes. Top line revenue growth, absolutely strong double digit. EBITDA growth, yes, EBITDA is growing. Strong free cash flow, yes, strong free cash flow. Low debt is 0. And well priced, yes, even if it's 40, 50 times EBITDA market multiple, I think, or yield if you want to look at the yield perspective, I think it was at 4.4. Even with those yields and that market multiple, given the growth potential you have over time, the track record of performance, and the current sale price, I think it warrants a look into this stock. Let me know what you think on the channel. Let me know in the comments what else you'd like to see. I'm happy to review them. If you want to learn how to do this type of analysis, I do teach a course on cash flow investing. You can find it at cashflowinvestingpro.com. I provide this worksheet to you. I walk through the Apple Corporation valuation, how to calculate EBITDA, free cash flow, how to forecast, and what these numbers mean. And you can do it yourself. There are 3,600 stocks trading domestically in the United States. You need to pick 20 of them to hold long-term for your portfolio, and it can and does work. And I challenge you to put aside the computer, put aside the day trading, pick up a 10K, pick up a beer, a cup of coffee, and sit there and read it and just think. And I challenge you to do that for a year, picking through a 10K a week, a 10K a month, and reading through, and you will be surprised how quickly you get the cadence of the way they're organized. You will gain perspective because you would have looked at so many over that period of time. You will be able to quickly judge on a basic level who has their stuff together and who does not. So please take the challenge. Let me know what you'd like to see on the channel below. I'm happy to take recommendations. My name is Cameron Stewart, CFA. This is Rational Investing. Thank you very much for the time. Take care. Bye-bye.